Welcome to the latest webinar update on the Upstream Energy Fund VI. Very excited to share with you the latest updates in this fund, whether you're a current investor and wanting to get the updates on the latest acquisitions in the fund, or you're new to this fund and you're wanting to jump in before we close out here in the coming weeks. Excited to fill you in on all the latest things that have been happening. So I'm going to dive in here. We have a full webinar presentation you can watch that goes a little more in depth on the fund strategy, projected returns, and taxes, and all those kind of things. So you can watch that in the data room. This is just a quick update to give you just a little bit of an overview if you're newer to this fund, of the strategy, of the target acquisition, and some of the basics of the fund, and then to update you on the latest assets that we have purchased. So with that, let's dive in. So this is our 116 Upstream Energy Fund VI. And again, this is not an offer or sale of securities. Got to consult the PPM to review all the risk factors to make sure it's a fit for you. Also, you can reach out to other advisors and those that can help you evaluate those risks. I'm going to skip some of the management team here because I went to full bios on the full webinar, but we have 4 partners here. And one of the things that's important for you guys to understand is that we're all putting our own cash as LPs into this fund, as we do in every single offering that we bring to our investors. And can read more about the bios in the full webinar. I do want to highlight, though, our partners in this fund. So we have partnered up with Mahajra Energy Advisors. Jeff Mahajra is the president and CEO. They have been in oil and gas consulting and advisory for over 40 years. And so they started 40 years ago, actually Jeff's father, in advising. Their background is in engineering and geology, and advising on large operators and their drilling programs, doing the analysis of the geology, and had advised on over $500 million of drilling programs over those years. 20 years ago, started doing their own funds and projects that they self-managed and have had a great track record. Historically, have only ever raised money from family offices and larger equity investors. And in this fund, we've kind of partnered up together to be able to bring in institutional equity alongside of our retail high net worth investors, and kind of creating a larger fund to then go access better middle market opportunities. Bob Boehner is his EVP and responsible really for a lot of the back end of due diligence, operations, infrastructure management, and financial reporting. Been really great to work with them and have an impressive track record, which I'll show you here in a minute. Again, I kind of mentioned this, but really how we find offerings and present offerings for investors, it's really driven by this simple approach that we use, which is looking at key macroeconomic trends that are in play and likely to continue for a period of time. And then we want to identify the best asset classes, strategies that are going to benefit from those trends. And then we put the best in class teams and investor friendly structures together to present really best in class offerings for our investors. Then, like I mentioned, we invest in every deal right alongside all of our investors as LPs. So we have alignment of interest and we have skin in the game. Here's a little bit of our track record. I'm going to run through that there. So let's dive into this fund. What is the fund? The Upstream Energy Fund VI. What is the focus here? So there's a lot of different types of offerings in oil and gas. If you're newer to this space and investing in oil and gas, you really need to understand the differences, right? So, at a high level, a lot are focused on pure drilling programs or drilling plays. And what they're doing is they're front loading a lot of drilling costs. They are going and drilling, say, one well or a combination of wells. And by doing that, they're accelerating some of their costs in the kind of front loading it so that they can get a big tax write-off right before year end. So you've probably seen some of those. Oh man, huge tax write-offs. That's awesome. And while those are real, the thing you got to realize is when you invest in those types of investments, they are inherently much more risky. You're gonna have a much higher variance of return because you're investing in new potential production. And maybe you hit oil on those wells, maybe you don't hit, or maybe you don't hit economically, right? So there's a much higher variance of returns, even though you get good tax benefits. But our approach has been, let's create the maximum opportunity for maximizing shareholder value and total return while also being tax efficient. And so what we're doing is we're going after and targeting producing, proven producing wells. And what we're doing is buying existing cash flow streams from existing wells that are already in operation and have proven reserves. And we can buy that cash flow stream at a nice discount rate. And what we do is we leverage the cash flow being generated from those producing wells, and we can plow those back into the drill bit. We can basically reinvest those earnings back into new drilling, which generally have higher IRRs and can basically create this snowball effect of increasing cash flow over time while taking less risk because we have those producing wells that we already have generating cash. And so that's really our focus. And the other kind of the layer here is the types of oil and gas investing that you can do, which can include royalty interest or working interests. And in our case, we're focusing primarily on non-operated working interests. If you're curious what that really means, we have a whole masterclass called our Oil and Gas Masterclass where you can watch that and learn all the terminology and the differences and the pros and cons of all of them. But we really think it's kind of the best way to play this because we are partnering right alongside large scale operators. And you'll see here on a list here in a minute of our operator list. And lots of them are publicly traded companies, very big, experienced companies with great track records that we can basically get the benefit of investing alongside of them with all the tax benefits, with all the upside, et cetera. So we think it's a great way to scale and to get exposure to this asset class with taking the least amount of risk possible, working with large operators in proven basins. And that's what we love. Here's that masterclass for you. You can watch that here in the data room. We have a link to it. Here's some of the reasons to invest. Like I mentioned before, experienced sponsorship team, a long track record with impressive returns in those past 5 projects and funds. We're going for middle market opportunities, right? This is not small mom and pop operated oil and gas wells. These are large, operators with proven track records, large capital, balance sheets, and proven basins. So this is kind of the focus here, going after bigger opportunities in the market. Again, we're focusing on cash flow and total returns. There will be an element of distribution yield they'll be paying out. There are great tax benefits. So it's not the pure just write off all your investment in year one, but we do expect a lot of the cash flow being generated, if not all of it, to be tax deferred during the fund life, given some of the drilling that we plan on doing and the cash flow being generated. We have a whole section and in the masterclass talking about the macroeconomic picture around why oil and gas investing is a great place to be right now. Listen to our podcast if you haven't listened to that. And we talk a lot about why we like this asset class, and there's a lot of great data there. I don't have time to go into it right now. Lastly, we invest alongside of our investors, like I've mentioned before. Here's the track record of Mahajer. Again, five projects. 4 of them are realized returns, full cycle deals. 1 is currently unrealized. You can see here IRRs are very impressive. Again, this is no guarantee of any success in this new fund. We can't make any guarantees of returns, but you can see the track record here over a long period of time has been successful. They've advised and have owned assets in most basins, key basins in the lower 48. Here's the fund structure. So it's a $100,000 minimum investment, 70-30 waterfall to the LPGP. We are projecting a 10-year hold, but don't necessarily anticipate having to hold for the whole 10-year period. The reason we have that is, in this asset class, timing really matters on when you sell, when you buy. It's a great time to buy right now. We think over the course of the next 10 years, it'll be a good time to sell. We will opportunistically sell if it makes sense. Otherwise, we'll just keep making really nice cash flow. We're targeting kind of a 25+% annualized return with a total equity multiple over that 10 years of, 4%, 4 times up to 7 times. We're planning quarterly distributions. We have a little bit of leverage on the fund, which I'll discuss in a minute. And we also are employing a hedging program to reduce some of the volatility and the risk of commodity prices going up and down. So really taking a institutional level approach to this. Our goal here is to have a 1-year capital raise and deployment period. We started this capital raise kind of late summer of 2023. We are actually going to be shortening the capital raise period. So we have had such great success from in reception from investors that we're really close to finishing out the capital raise on this fund, and we'll likely be shortening that. We have a deployment period. We've already purchased one asset. We have another asset under contract, which I'm going to get into here in a minute. And then we're going to kind of finish deploying the rest of the capital over the next 6 months. Plus, we might extend a little bit if we need a little more time. Um, and what we're doing is basically you come into this fund. One of the great things right now as an investor is you're coming in at the tail end of the fund, so you get to see the assets that we've already purchased and get the benefit of that. And if you're an investor that's already in the fund, it might want to put a little bit more into the fund based on the assets that in the acquisitions we've already made. We anticipate those to be very helpful for you to make that decision. What we're targeting and expecting is kind of first year of the fund, we're going to be reinvesting a majority of the cash flow that's being generated from those wells back into new drilling. But part of that is contingent on the available drilling opportunities that we can participate in with our operating partners. And early indications are showing we may be able to send distributions a little sooner than expected. So no guarantees on that yet. There's still a lot that remains to be seen in 2024. But we are expecting at least the possibility of sending distributions a little bit sooner than expected in 2024 to investors and kind of start a targeted distribution yield that will grow over time as we continue to reinvest and grow our profits. There's two ways to invest. You can review this in the PPM in the full webinar. I'm not going to get into it now, but as a limited partner or general partner, here's some of the key risks and mitigants, which I'll go into in the full webinar. So here's the actual first acquisition that we made. This was acquired in September, middle of September, and we love this asset. It was a $30.5 million purchase. So it will make up probably roughly half of the fund's assets. But we're very glad about that because it's just a crown jewel of an asset to have in the fund. A lot of great existing production, 143 wells that are already producing. You can see some of the production numbers here. It's a mix of oil, gas, and natural gas liquids. Really, we found this deal as off market and purchased it from a large private equity fund where they were basically, this is one of the last non-operating working interest assets that they had. They're an operator. And so they were kind of redeploying capital from deals they don't control the operations to sell those and go reinvest it into where they are the lead operator. So they're a multi-billion-dollar fund. We purchased this from at a pretty incredible discount rate, which you'll see. One of the great things too, aside from just existing production, we have 68 potential developmental drilling locations that we can participate in if we choose to, that we expect to be drilled over the course of time. And so these are already kind of proven but undeveloped drilling locations. So we know there's proven reserves in the ground. It's actually an SEC designation that's been given to these locations, and eventually expect drilling to occur. The great thing, a lot of times, different parts of the market and the cycle, you have to pay up, kind of pay a premium when you have these PUDs, proven undeveloped locations. We didn't really pay up for these, so it's kind of that extra gravy that we get in this acquisition. So I mentioned about 143 wells. We purchased at about a 19% present value. So that's our kind of unlevered cash on cash return, or cap rate, if you want to remember with real estate terms. It's in the Scoop-Stack Basin, and again, 68 proven and developed locations. So that one's been purchased. It's already off to the races, and very excited about that. Our next asset that we're purchasing is about to be closing here in the first week of January. So we are bringing in additional capital and going to be kind of finishing that up. This is another great asset. It's really complementary. We kind of view it as a bolt-on acquisition to the last acquisition. It's again in the Scoop-Stack, and it was actually purchased directly from one of the executives of this private equity firm that I mentioned that was kind of required to invest in some of the new operations that they're doing, and was selling this really kind of as very similar numbers from a present value standpoint as the first acquisition. So not as large. This one is a $10 million purchase. And you can see some of the production there. Again, a nice mix of oil, natural gas liquids, and again, very much of a bolt-on. So it's very close to some of the other wells we have. Get some economies of scale from that, and we also get some other upside from. There's another 5 potential drilling locations that are already identified. Again, those can always grow over time, right? These are just locations that the operators have already identified. They may identify more on our acreage over time. But again, we have some upside that we're not paying for with an additional 5 potential drilling locations. This is a non-operating working interest, just like the other acquisition. Another 29 wells, about a 19% present value again. So again, very similar numbers from a cash flow standpoint, and about 5 PUDs. Here's where the scoop stack in the Anadarko Basin is. It's mostly in not Arkansas, Oklahoma. And it's a very sought after drilling location for oil, predominantly is great geology, very high initial production, generally competitive drilling costs, and great infrastructure. So there's a great takeaway capacity, which we talk about in the master class, but basically meaning most of the production is being generated at the wells are able to be transported and ultimately end up at the end consumer. Whereas Permian Basin, there's a lot of flaring going on, meaning they're just lighting money on fire when they can't transport the natural gas that's being generated in excess to the end consumer. So there's great infrastructure, which is a really key component when looking at the basins. Here's a list of some of our operating partners. So there's 169 wells in total between these 2 acquisitions that are currently being operated by 8 different operating partners. You can see here 5 of which are publicly traded, very large market caps. You got Marathon, Continental, Devon, Cimarex, Ovintiv. Very large operators with great track records. So this, again, reduces some of the risk by having multiple operators and having larger operators that are well capitalized. So you can see in a data room, we will provide an updated model for a combined pro forma analysis with both the first acquisition and the second acquisition. And as we have more acquisitions, we'll continue to update that model. But so far, very much in alignment with kind of initial expectations for the fund, kind of IRRs based on several assumptions. But you can see those in the pro forma. So right now, we're very excited about the 2 assets we have so far. And again, we are kind of shortening this race. So we are expecting to close this fund in the next several weeks. So if you have any interest in jumping in this fund, we encourage you to reach out to our investor relations team to have a conversation, ask the questions you have, make sure it's the right fit for you. But again, we are expecting to be closing this fund out very soon and off to the races to buy the rest of the assets in the fund and execute our business plan. So with that, hope you enjoy this kind of update on the fund. We're very, very thrilled with what we've seen so far, and expectant for the future acquisitions in the fund as well. So again, jump in to the data room and review what we have there. Schedule a call with our team. And if there's interest, please schedule that call and have those questions answered and see if it's a fit for you. Thanks so much.